In previous entries into our education series of videos, we have explained the voluntary carbon market and how carbon credits are created. If you have watched the series, you will know a lot more about the quirks and nuances of these important environmental instruments. As we have been explaining, PCX is a unique exchange that will allow carbon project developers to raise funds to support their development activities in advance of their projects issuing credits. The exchange essentially allows them to sell forward contracts for the credits they will eventually be provided to investors buying PERL.eco future carbon, or PFCs. This helps developers to solve their chicken or the egg dilemma of how to pay for the initial stages of developing a project when it has no income from carbon credits. But what is the addressable market? What volumes of funding are needed to kickstart more carbon project development? In one of our recent Medium posts, we shared some important research from Morgan Stanley, who have estimated that we will need to achieve at least 1 gigaton of carbon removals and reductions by 2030. That is 1 gigaton, or 1 billion metric tons of carbon dioxide or its equivalent each and every year starting in 2030. If you think that sounds like a lot, you would be correct. It took the voluntary carbon market over 10 years to create 1.7 billion carbon credits total. Based on recent years' issuances, we will need to produce over 700 million carbon credits, more than we are producing at the moment, if we are to come close to being able to retire a gigaton worth of credits each year. As we covered in previous videos, the development periods before projects start to issue credits are measured in years. A high-quality carbon project developer would need a minimum of 3 years to take a project from start to issuing its first credits. This means the work has to start now if we are to have any hope of hitting our 2030 targets. But how much money are we talking about? How much financing will it take to bring all these additional carbon credits on stream? To understand that, we will need to know what is the average cost required to develop a single carbon credit. This number can be notoriously difficult to calculate, as no two carbon development projects are the same. Typically, carbon projects need to pay for the time of experts and survey teams to undertake the technical work. They need to pay for capital expenditure in relation to protecting and conserving the land and water, and finally, they need to pay for verification and validation expenses to allow credits to be issued. These validation and verification costs can be as high as $40,000 a year for an average-sized project. Now, we have a deeper understanding of the costs of carbon project development, thanks to Trove Research, a leading data and analysis firm focused on tracking and assessing corporate climate commitments and all aspects of the voluntary carbon market. Trove Research has recently published its in-depth report called The Role of Reduction and Removal Projects in the Voluntary Carbon Market, an Economic Analysis. The Trove report is important because it is one of the first analyses of its type to develop a model approach for estimating the costs of different types of carbon removal and reduction projects. While a lot of analysis has focused on the growth of carbon markets, there has been little information available on the levels of investment that are required to achieve the necessary reductions. Trove places the average development costs of one nature-based carbon credit at $12 per credit, with a high estimate of $20 and a low estimate of $9. That is $12 for each of those 700 million plus carbon credits that need to come on stream by 2030. That equates to several billions of dollars in additional funding that is needed in the near term. The report also looks to the future, where it predicts that the cost of developing a single carbon credit will be an average of $50 by 2050, and the upper estimate is as high as $200. That is billions and billions of dollars in additional climate funding. If PCX is able to capture even a small slice of this funding market, the exchange will deliver substantial income in listing and trading fees. How that income is deployed will be voted on by the PERL community, whether it is funding airdrops, rewarding liquidity pools, or financing token buyback and burns. PCX will be the first regulated exchange of its kind, tapping directly into these new financing requirements. PCX will be launched ahead of the prestigious COP28 Global Climate Summit taking place in the UAE this year. So to keep yourself informed, please subscribe and hit the bell icon to be notified when our next video drops. Thank you and take care.